Okay, you see the message there that we have the recording started for week 10. We do have, I did put out an announcement that went to review the contents of what we're doing in class today, as well as what I put up on Blackboard. So I'll review that right now at the start of class. So that includes the midterms. We will take a break if there's only 8 of us. I won't put you into breakout groups. We'll just do it live, and maybe I'll go in the background and let you guys have a bit of a conversation there. We could go over a little bit of the claims, but I want to spend more time today on the reinsurance because that was the part at the end of last class where I went through more quickly and the video would have dropped off a few times. So we'll pick up some of the items on reinsurance that we missed. And then, as I have up on screen there, test 2 is open as per our regular plan for this class. So it'll open today. Normally you would have 1 week to do it. I've extended it for 3 weeks just in case we are interrupted with the strike. So it will give you some learning material to go through and lots of time to go through the content. And this test is a little bit of a recap, but mostly focused on reinsurance and the claims recovery. So just what we've done over the last 2 classes. Okay, so is that good? Sound like a plan for everybody? All right, so I will just drop, where we go over the midterm and the case study, I'll stop this, I'll show you. Oh, let me just share my screen on Blackboard in case you didn't see where these items were. Because that midterm was mostly on module 1, I put the answers. There we go, module 1 had all these items. I put test 1 answers there. Midterm answers within this item, there's a Word document that has the responses to the short answers, and it has the Excel document too. Okay. At 1 o'clock today, under tests, and you might get a pop-up notification, but the test number 1, it says release conditions here. This means it'll be at 1 o'clock Eastern time. This test 2 will then be open for you. Okay. So the time limit, 180 minutes, but it gives you extra time for a whole another hour and a half after that. So I think there's lots of time, and there's unlimited attempts. So, and I'm sure as you've figured out with those Excel sheets that you could download, there's nothing stopping you from downloading, going on, working on them, then starting another attempt and then uploading it. So it's, again, not geared just for a mark, it's geared so that you're understanding the material. As long as you're doing it on your own for the test using the resources, then as long as you get something attempted and submitted, then that's what I'll grade. So not too fussed on the time. Okay, so let's jump into, I just want to highlight a couple of things on the midterm where consistently it was missed. If you have any specific questions, maybe we could take a quick Q&A now. And if it gets to be too much, then send me some messages online and then I could give you some individual feedback. But take your time in going through the complete responses that I've provided. Okay, so here is what the worksheet looks like for the midterm answers. Oops. Okay. So the first few worksheets are designed. This is the blank templates, all in one worksheet. And then the ones that are suffixed here with A and S, that's answers. Okay. So for the most part, the T accounts, I think everyone's getting it. They were done very well. You know, I was a little bit, I wasn't too specific on, you know, how the UPR was done. Some people did the UPR from the first transaction and did the $1,000 adjustment. Some people did the 12,000 and then the 11,000. So I gave full marks for that because I know it was a bit confusing because I was teaching that as soon as that written premium goes up, then you set up the unearned UPR. The way the question was worded was just do the written premium in question part 1 and then do just the UPR for the month in, I think it was question or part 4 of that. So in any case, I didn't deduct marks. I was looking to make sure the debits and credits were on the right side. So it might be if you had the right amount, but in the wrong column, that was just part marks. Again, if it's a liability, we want a credit. And if it's an asset, we wanted a debit in the reserve accounts. And the offset is the change in accounts. So I don't want to spend too much time on that because everyone did very well on this one for the most part. The claims specifically, because we've been doing quite a few examples, these were done very well as well. The UPR and the DPAC I know are tricky, but I was impressed with most of the responses that came in. This guy here, again, hit or miss. Maybe the layout and what's being asked is confusing. I forget now if the template had the formulas, but when we went through it in class, I was recommending that if you, instead of just putting in, you know, your 2 impacts, make sure you're doing the totals so that you could check that your, sorry, it's moving around on me here, that your impact to assets matches your impact to equity and liabilities. So those amounts should always be the same. Then you know you have the signs and the totals correct as far as the impact and liabilities go, and bringing in this net income amount so that your equity is impacted. Again, I think for the most part that this part of it, of bringing your equity or your income up into the equity on the balance sheet, was done well. Just a few places to make sure that everything was balancing. You're not doubling up on an entry. So again, the only one here, and if you recall this question, I also had on test 1, and I explained that this was, you know, pretty complex. In the answer key, I have the formulas in here, so you could, you know, not just follow the amounts, the dollar amounts that you see, but actually the formula. So maybe a couple people picked up on this. It was similar to the way the question was designed from the test. So you could have went to that answer key to give you that, that push or direction. So the idea with all of these amounts here that were bolded that you had to fill in, it was that all of these accounts have a related change in account, right, in the income statement. So this is the UPR balance. So we have the opening and we have the change in. So that's the amount that you'd use to get your ending amount. So the signs, whether it's increasing or decreasing, you know, might be tricky. In this UPR case, we're bringing 4,000 into income. So if you go back to the change, we want to increase income. It's a credit, which means we have to debit the liability, and to debit to the liability is a decrease. So lots of concepts there. I know that's the thought process. The whole idea is I want you just to recognize that what happens in the balance sheet in these accounts, especially these reserve accounts, are related to what's going on the income statement. Okay, so There's just a couple of marks for that. It's probably worth a lot more if you got it, but I know it is tricky, so that's why I don't penalize you by putting a large grade on figuring this out. So I think bringing forward this and the totals, a lot of people got, and they were trying to back in to what it might be, knowing what, you know, these totals were. So there was grades for that, right? Because we know that our assets and total need to match, and you get back into total liabilities if you weren't able to get it, you know, from this formula. Okay, so that was how to fill in these amounts. And again, you could review the formulas in here afterwards. The last piece then was on this combined ratio. So I'm not even sure if anybody got this 100% correct. So what was missing was this whole concept of underwriting expense. So total underwriting expenses, and I sort of led up to it in the short answers by, you know, asking the question, what are the total underwriting expenses? And you all replied, well, it's commissions, underwriting expenses, and premium taxes, right? So all three of those together are what's the used in the total expense ratio. And it's, the terminology maybe is tricky, that it's the total expenses, but it's not. Underwriting expense is just one piece of the total expense ratio. So this expense ratio is just the underwriting expenses, and you guys figured that out. This is the underwriting expense divided by the earned premium. But when you get the core, you have to also include the commission ratio. And if there were premium taxes, you would have to include the premium tax ratio too. So it's all of the expenses, commissions, underwriting expenses, and premium taxes together that match the total underwriting expenses, and then total underwriting expenses plus claims is your combined. Okay. So a lot of you would have just, I think, would have put the 69 plus the 19 as the combined ratio. So that was, I mean, maybe half a mark or a mark, but the other Q should have been, you know, here I'm showing underwriting results as a loss, a negative amount. So the Q there is, if it's 0, that's when you get your combined of 100. And if you have a loss, your combined ratio would be over 100. So if you came out and you only had a combined ratio of 90 and it was a loss, that would have been an indication that something was wrong in the calculation of the combined ratio. Because if underwriting results negative, your combined ratio is going to be over 100. So that's why we talked about this alternate calculation for combined, where it's 1 minus the margin, right? 1 minus underwriting result divided by your revenue. And I think some of the, yeah, that wasn't an answer to one of the multiple choice ones, but we talked about that as well, that this is another way to look at the margin to calculate the combined ratio. So asking you to do it both ways, it wasn't on the test, but I've just shown it here so you could see the formula, that you get the same response, sum of the ratios, or 1 minus the margin. Okay. So that was a quick 10-minute, just highlighting some of the areas that I saw consistently we should talk about. Go through the responses. Some of the concepts will flow through to the final, because again, it is all a building block, as you're seeing when we talk about claims and reinsurance here. So make sure you do understand it, know where the mistakes were, and at least when you see them again, you know where to reference them in the answer. So is everybody okay with that as a review of the midterm at this point, I'll give you a minute to just pop in any questions in the chat or take yourself off mute.
Very good, Professor.
Okay. All right, so if we jump back to what we wanted to do today, looking at big. Oh, come on now. So I've been leading up to this for a couple of weeks and just checking. Oh, a couple more people have joined in since we started, so that's good. 11 in class right now. I do want to hand the discussion over to you just for a couple of reasons. One, it gets you hopefully used to talking about the insurance company's results with some of the finance related vocabulary that we've been using, and then get you thinking about what questions you would be asking when you see specific results, and then ultimately we'll get to the point when we talk about reinsurance, what solutions might be there, what actions could management take, and what's to get expected results looking forward. So that's what we have here when we look at the financials. And just so I have it here, I'll download the PDF that's related to it as well. And again, hopefully you guys have reviewed these independently. Okay. So since we're not actually 6 people in each group, maybe that's the best way that we can do it here. So maybe I will put you into 2 groups. I want one group to look at HIG and its structure, trying to pull out the good points and the positive points as if you were the management company, and what actions you've done in the structure. And then when you look at the financials, focusing in on the income statement, we have, I know it's a lot of numbers in here, but I did want to break out, again, the actual years, and then this is their projection years. What types of questions would they be asking to uncover what's happening in the claims? What could be causing the claims going up? And then what would be reasonable to predict that the claims would be dropping off? And as far as the ratio goes, not just the dollars, you could see the gross claims ratio increasing, and then the sudden drop. So we talked last class about the different components of the calendar year loss ratio when we talked about accident year and prior development and catastrophes and getting to an underlying. So let's have group 1 look at asking those questions, looking at what's positive, why this could be a realistic plan. And then group 2 would be more pessimistic and say, here's why these things don't make sense. What challenges would you give to this type of plan? Where could you poke holes in the results? So you're not going to have all the answers, of course. I just want you to have the discussion to get used to trying to drill down onto what the impacts could be. And that was just example for claims. You could have the same discussion on premiums We could pull out a little bit of the structure, using the words from this draft press release, just to focus in on what they're looking at as far as what's driving the combined ratio up and down, what's driving some of the premiums. So just a free-form discussion. I'll give you 10 minutes in the groups. That's it. But then I'll bring you back and we'll carry on the discussion, which we can all have together. So again, group one, more optimistic view of, why HIG could get to an improved combined ratio. And then group two, more pessimistic view of what challenges would you have on a plan with premium growing and claims ratio coming down. Okay. All right. So let's try this. And hopefully you have these documents, or at least somebody in your group would have them to pull up and share screen with you in your breakout room. Here we go, breakout. Oh, there's the button.
Time.
In 2022 and 2023.
Yeah.
Right?
That's good.
They do have this up the claims time, then it means that you should be able to reduce the claims.
Data we are the main class.
Brittany, we are black in class.
Back in class.
Right? I don't know if
Oh.
I'm making sense here.
But I got your point. You're back in the middle. Thank you, Henrietta.
Okay. I'm not
All
sure
right.
if that actually affects the net claim ratio, because under it also increased the percentages and the net claim ratio decreases for 2022 and 2023. They wanted to decrease, right? I'm not sure if that actually affects it too.
It could be a factor.
Yeah.
Your insights, Henrietta.
All right. Welcome back, everybody. Hopefully that was okay. A little bit free form. Somebody from group one want to give us a few points that you guys focused in on, and then we'll switch over to group two after that.
Okay, Professor. So we are group one together with Aditya, Henrietta, and Urusha. So guys, if I missed anything, just butt in. So we identified some good points. So coming from like an underwriting loss in 2020 and 2021. So the projections for 2022 and 2023 are positive. So meaning it's an underwriting gain for them. So one of the things that we looked at, there's a big jump in the net premiums written from 160,000 to 178 and then 186. So what could be the factor here? They've decreased the ceded premiums. So they have decreased the reinsurance activity, and this way they were able to keep more premiums for the business. So that could be a good thing for them. Another thing, we also looked at the claims. So from 2021 figures, net incurred, ceded claims as well, the gross claims. So they've decreased that as well. So we were thinking, because it mentioned that they phased out of other insurance business classes that they are not good at and instead focused on complex commercial and personal property insurances. And in that way, by focusing on what they're good at, maybe they were able to do some great underwriting activity because they know it so well. You're also thinking maybe they diversified as well in terms of the businesses or that they are covering in order to spread the risk and maybe contributed to the lower claims. And as Henrietta was saying, she pointed out that it was mentioned through the press release that the claim staff is dedicated to fair and timely settlement of claims. So that could be a factor as well in in having projecting lower claims for these years. It also mentioned that the company invested in partnered with InsurTech, so it's an innovation, and we were thinking it also helped the company like write good businesses as well, which could help increase their revenue. So I think I'm not sure if I missed anything, but basically those are the points that we discussed among the group.
All right. Very good comprehensive review. I'll come back and comment on some of those and help align them and mostly agreeing with what you guys pulled out. Somebody from room two want to maybe give the more pessimistic view or challenge that you would give? Even if you each give 1 point, hopefully.
Yeah. Hi, Professor. Good morning.
Hello.
So I would like to highlight the net premium written, then
Okay.
net premium earned. As we can see, it's increasing constantly. but at the same time, the expenses are also increasing.
Mhm.
So I feel based on the past results, although being positive is a good thing, but it might not it might not lead to, being the being right.
Mhm.
So yeah.
Anything else from room 2? Give. All right, let me just touch on a few of those things. If you have anything else to add, actually, let me monitor the chat as well. So I think what we did see, yeah, I want to watch the time that we're not, because we could spend all class on this too. I'm going to send another updated spreadsheet, which breaks out this GWP change. And as room 1 noted, that one of the positives were that the net premium earned is increasing faster than the gross, right? Because this is the drop in reinsurance. So their actual revenues are projected to increase more because of the reduced use of reinsurance, right? That's one part of that term, retention. Their net retention of their premiums is more because they're ceding less. Okay, so that's the retention of net premium to direct premium. Okay. The other increase that was commented on was this by both groups was the increase in gross direct premiums here. So that's, twofold. And that's the other component of retention. So that's where they're retaining the existing business, plus maybe they're writing new business, plus they're getting some rate changes. So I'll share, just the logic of what assumptions there are as premiums move on a gross basis from year to year, looking at rate, new business, and retention. Just something else to focus in on, because that's generally how, is it realistic what's happening with growth? So I'll share that separately. When you look at the ceded business going down, so you are going to have less ceded claims. So one ratio you could look at is say, what's the ceded claims versus the ceded premiums to see, is it a good deal for the insurance company or not? Taking out the, more detailed look at commissions that would be related to it in some cases. But in 2021, they paid out premium of 64,000, and let's call this in millions, 64 million, and they recovered 45 million. So that means the reinsurer would have made $10 million because the reinsurer would have received 64 and only paid out 65. And in each case, the company is paying more in premium than in claims recovery. So maybe that's one reason they'd say, look, maybe we don't need that much reinsurance because we, over even a long period of time, we're not recovering all of our costs. So they're projecting that even though their reinsurance drops, it's a significant drop in claims that they're recovering. And then the last item, when we look at the gross claims, and I didn't catch it from the comments from either group, I don't think, but it's related to potentially changing the mix of business. So if they were writing different types of business in the past, and then around this point they stopped and focused just on property, the company's still in one area going to still have a lot of reserves, say on that older business. So those claims could just be being settled now. So this increase could be related to unfavorable prior year development. And that's causing these increases now related to premiums and claims they underwrote before. If that's the case, then maybe it's reasonable that it would drop off because you've already gotten rid of all your unfavorable, but your underlying business now for 2021 might be lower and consistent with what you're writing in 2022 and 23. And the other impact could be if there's large catastrophes, if they are a large property writer, which they are, there could have been a catastrophe which is having more of an impact in these years. And whether it's reasonable or not, maybe they're not planning that the catastrophe losses will continue in these years. So let's just check on, okay, so all those items I just mentioned would be questions you would ask because you don't know because the information is not provided below. So when I send out the next view of this, I'll include here's what prior year development was, here's what catastrophe was, and then we could see what the underlying is and if that trend makes sense, and we could talk about that next time. And then the last point that room number 2 made was just on these underwriting expenses, and it's tied into any R&D that they might have been doing, to develop their InsurTech ops. So their underwriting expense dollars have been going up, and you could see their ratio is kind of maintaining and actually decreasing, but it's decreasing, and you guys picked this up on the test, that even though the dollars are going up, these ratios are based off net earned premium. So when they drop their reinsurance, increase their net premium, it's going to have an impact of reducing the expense ratio. So that's one way the insurance company could cover their expenses better by keeping more of the premiums and using less reinsurance. Now, they're at more risk of potentially higher claims, so they have to watch that their claim ratio doesn't increase on a net basis too much when they drop their reinsurance. Okay, so that's just some points. I think that was a good discussion. Could carry it on the next time we have a class as well, and I'll share with you the next view of this spreadsheet that has more details again on premium development and drilling down on the claim reserve. Any other comments from anybody? I liked how you guys use both the facts from the PowerPoint as well as the numbers. Okay. All right, so I'll come back when we talk about reinsurance, relate it to some of the observations in HIG here. Let me just switch back to our PowerPoint, and again, this is on Blackboard, so you could follow along there too. Okay. Oh, I took a break when you guys had the breakout rooms. Let me just get started here, and then we could take a, give me 5 minutes, and then we'll take a 10-minute break, okay? All right, so this is what we've been talking about. We're going to focus in on reinsurance here. I just want to give a bit of a backdrop before we get into the discussion. So what we're going to be talking about, again, focusing in on the reinsurance, is this idea of the ceded premiums, that this is the transfer of risk to the reinsurer. So we've talked about that a lot. It's in the insurance for insurance companies. Last class, we talked about some of the terminology. So let's just do a review of this, and then we'll get in, take a break, and then go into the reasons the company would buy reinsurance, and then ultimately how claims are recovered against different types of reinsurance. So everything that we've been talking about in this class is from the viewpoint of the insurer, right? So this is the company that issues the policies to the individuals. And as you've noted in some of the questions, that the contract between the policyholder and the insurer, that one is one contract. So the insurer has a responsibility to pay the claimant. Separately, the insurer has an agreement with the reinsurer, and if there's premiums to be paid and claims to be recovered, that's a separate contract between the reinsurer paying the insurer. So the reinsurer does not have a relationship with the actual policyholder or the claimant. And there's different, we'll get into the different types of contracts that the insurer could have with the reinsurer. The other ways that this company you might see being referenced is either as the company or the ceding company, the cedent, or the reinsured, because they're the party that's being reinsured, protected by this agreement. The reinsurer is a company assuming. So when we talked about gross premium and gross claims is equal to direct plus assumed, this is the incoming amount that is assumed by the reinsurer. And they could be known as the market, i.e. the reinsurance market, or the assuming company. These two definitions are probably the most clear, right? This is the company doing the ceding, and this is the company doing the assuming. And then this whole idea, you might see this term retrocession. That just means that the reinsurer then groups its risks and has another reinsurance contract with a different reinsurer. So that idea of a reinsurer entering into another reinsurance agreement, that's specifically just referenced as a retrocession agreement. So policyholder Jason would have a contract, an insurance policy with Intact, the insurer. Intact would have a separate reinsurance contract with, say, Swiss Re. So Swiss Re is the reinsurer of Intact. Swiss Re might say, group all of its policies and contracts and say, I want Munich Re to provide an agreement over parts of my portfolio. So then Swiss Re would have a retrocession agreement with Munich Re. Munich Re would assume those risks from Swiss. Okay, so those are examples of the parties. And just like on the, I might use a broker to place business with Intact. Intact might use a reinsurance broker to help them place their reinsurance program with multiple companies. Okay. So let's take, we'll take 5 minutes and then we'll go into more of the details that we breezed through too quickly last week. All right, so we got, it's 11:45, 11:50, just a 5 minute, hopefully that's good for you. Okay, welcome back, everybody. If you're getting settled in, have a guest speaker jumping in. Professor John is going to take the class for a second. FYI, we're recording the session right now, and I think I have nine students in class today, John.
Awesome. Thanks so much. And thanks, Jason. So, hey, everyone. And thanks again, Jay, for just letting me pop in. You're the one group that I just wanted to make sure that I touched base with, because you were my first group of the week when this announcement got announced, and we weren't sure just how real this was going to be and how much traction it was going to gain, but it gained a lot over the last couple of days. You've probably received a fair bit of communication from Humber just in terms of what's going on. So I'm going to give you a couple different things, and I want you to, these are just some food for thought. One, this isn't the first time that this has happened in our program. Our program's been alive for 4 years, and Professor Annette and I always joke about how we never had a normal year. The first year we launched the program, we launched it in a year of a strike. And you can ask Professor Jason, because he was one of the original professors that helped me kind of steer the ship through the whole situation. The next year, we actually kind of had a little bit of a normal year. And then the year after that, it was COVID, and then online COVID, and then online COVID with potentially a strike. So I don't know what else we could probably fit in, Jay. But I think we're pretty battle tested from a faculty in a program. So I just want to give you a heads up. So one, I'm in communication right now with the Insurance Institute. I'm in communication with the Insurance Brokers Association of Ontario, and I have spoke to Applied Systems. So we have a contingency plan, and we're working on a variety of different things. So there'll be some more information that probably comes out. You'll probably still be able to get a hold of me, but I have to be careful how I talk to you because I might get in trouble by Humber. So I'll probably give you my Gmail address for you to reach out to me. If a strike does happen, it'll happen today at midnight. All of your professors have put together a reading schedule or a study schedule for you to look at for the next 2 weeks in a folder that's called Working Ahead. Okay. The year that a strike happened with us, we actually had some of the highest academic marks in Canada. Okay. So I'm going to ask you to look at it this way. How many times have I talked to you about putting those 3 goals on a piece of paper and putting them in an envelope and putting them on the refrigerator? Okay. COVID hasn't come between your goals, all right, and neither will a strike. And you need to use this to your advantage. Look at it as another reading week. Right now you have multiple assignments, multiple exams, multiple tests that you're either preparing for or you're in the midst of completing. Use this time wisely, all right, to the best of your abilities, okay? Just realize one thing. This is not really something that any one of our faculty supports. And none of us even voted for it, but unfortunately we're being dragged along for the ride. So I just want to give you a heads up that you've probably seen from the beginning a strong willingness to put our students in the driver's seat and in the center of everything. All right. And that does not change. Just unfortunately, we have to follow the cadence and the rules of what's going on. I will be sending you out an email tonight, probably really late, depending upon what happens with the situation. It'll probably be right up close to midnight, and that will come with some further directions and some further information with respect to the college strike. But I'm just going to ask you to do one thing. Don't park your books, okay? Don't put your books over the side. You might have a couple days where you get mad, and you're mad at Humber, and you're mad at the program, and maybe you might even be mad at me. I didn't do anything wrong, but you might get mad at me anyways, right? But the fact is that don't put this stuff on hold, okay? You specifically, all of you have traveled, and if not, are in the process of traveling across the world to come to Canada. This doesn't get in the way of anything. It's a speed bump, all right? It's a small obstacle. We're all going to come out on the other end of this. And trust me, we already have a plan because we've already gone through this. And we'll stick to it. But just trust me, this is just a little bit of a blackout period, all right? And that's it. Look at it as a reading week, okay? To get caught up on a couple different things and say, okay, I don't have, like, reading week was probably good, right? Like, you didn't have any classes. You got to catch up on that. All right, use this to your advantage. I'm in close contact with all of our partners. It's not going to slow the employers down too as well. we're actually still looking at conducting an employer event next week, but you'll go to them instead, and that will be BrokerLink. Okay, so I've already been talking to them too as well. A lot of stuff has been going on behind the scenes, and you can ask Professor Jason. I've talked to each one of the professors personally on the phone. Okay, so just want to open it up just for a couple questions, and I have to jump into another meeting just at 12.
Hi, Professor John. Good morning.
Okay, Glenna.
So, like if the strike happens and like we want to get in touch with our professors, can we message them on LinkedIn, or do we have to go through to you in order to get to them?
No.
How
You
does
could
it work?
probably message them on LinkedIn if you wanted to reach out to them. Technically, they're not supposed to be talking to you about Humber content, but if you wanted to reach out to them and say hi or ask them about, you can reach out to me if you have a job interview or if you want some coaching on some resumes like, I've talked to you about. We will meet on a separate platform. Like we might meet on like Google Meet or something like that. Or something along those lines, but yeah, you can certainly reach out to them on LinkedIn if you want, just in case, but just be careful because we don't want anyone to get in trouble because by law in our agreement, we're not supposed to be teaching. But you probably could reach out to them on LinkedIn, but just use it as kind of a study period. You can reach out to me. Oh, if I get in trouble, I get in trouble. But at the end of the day, you can reach out to me. I'll give you my Gmail address for you to reach out to me. Okay.
Thank
John,
you, Professor.
I had a quick one, Professor John. Blackboard will still be available for the students to access their learning.
Exactly. Yep. So I just sent you an email, Jason, just with some more particulars on what's going to transpire. But students will have access to Blackboard, but professors will not.
Okay.
And Professor, so let's say the strike will continue for 2 weeks, and let's say we come back on the 1st of April, and we'll have our final exam scheduled on that week. So it will proceed as scheduled.
All the assessments will be put on hold, and what we will do is we will probably take 2 or 3 days when we come back to catch our breath. All right, and then the professors will probably have about 2 or 3, 4 or 5 days and maybe a weekend to pull together a new critical path, because Humber will come out with some guidelines on how far the curriculum has been stretched out. So it might go a little bit into May, and Professor Jason can attest to that experience where we had to build out some extra critical path. Last time it happened for a very long time, and we had to actually teach first semester into second semester. And then, but as Professor Jason can say, like we did it well. We actually did it really, really well. So,
and we do coordinate it. I mean, through Professor John, all the professors, to make sure you're not having all these final assessments or midterms on the same day. So that was the few days John was talking about, that we'll space it out, not just for our course, but for the whole program. So
yeah, so you're not going to be overwhelmed, and thanks, Jay. So you're going to get a new critical path, Glenna. So like tonight, if we go on strike, all assessments, they're not due. They've been paused. Okay, all due dates paused, all exams paused, and they will be moved. Okay, so that when you can come back, you'll be able to catch your breath. Professors will be able to catch their breath, and everyone will have a new direction and a new pathway with respect to completing the work. And that's what's going to happen. Okay. Okay. I have to jump out. I have to jump into an event. But if you need anything from me, feel free to reach out to me today and email me directly, or we can have a phone call. But and just as a secret, my phone number is on Blackboard if you need to contact me. All right. But Jay, thanks again for letting me pop in, and take care, everyone. Okay.
Thank you. You too. Okay, so I guess just carrying on from that. So that's in part when I was talking about test 2. I did extend it out to May. So I did want to open it up for you so you could get started on the material and start using it as practice questions, where Professor John just mentioned, right, this is the time for you to get caught up and, balance out still the workload that you have. So that's why I wanted to get it up today early so that you have access to it. You know, as far as the final due date, as he just mentioned, I mean, there is no due date, but I have 3 weeks, and hopefully we're all back before those 3 weeks are up. The other item, of course, for this class that you could be working on is that group presentation. So there's a discussion board that goes through, again, how to form your groups, some topic ideas. I guess I'll be able to give you some feedback over the next day or two. Or I guess you said midnight tonight, so maybe even it is just today. But that's not to stop you from looking at the templates, accessing MSA, and those types of things to help frame what it is you want to do in your group presentation. Let me think, what else could we add for this class specifically? I think that was it. In the workbooks, at the back of the workbooks, I might have mentioned last week, is a step-by-step guide to how to attack both the claims, underlying and attritional claims questions that I've been giving, and the reinsurance, how to calculate the ceded claims on different types of reinsurance. So those are step-by-step in the workbook, number 2 that you have. Yeah, so as you know, yeah, this class doesn't have any of the CIP courses, so I'm not as tied into that, but I know Professor John is, so he's very close with the Institute, so I'm sure he's going to have something figured out for you guys to help you prepare for those CIP exams. I don't know if those dates will be moving. That might be a question for him. Okay. All right. So always a challenge, you know, when you do get into the workforce, you're going to come across similar types of challenge out of the controls. But again, it's up to you to, you know, gain as much of this knowledge that we're providing in the class. So this is just another challenge. You might have to, you know, self-learn for a little bit, but Humber and the program will be here to support. All right, so let's jump back into reinsurance. I'll monitor the chat again if other questions pop up related to that, or you could send me a course message. Reaching me, if there is some blackout period, would be LinkedIn is the best way if I don't have access to Blackboard. So, okay, let's jump back into reinsurance here. Okay, so these slides, we either skipped through them last week or I took them out of the deck. So in the week 10 class presentation, I have these additional slides, some thoughts on why a company might buy reinsurance. It might be a little more in-depth in the workbook as well. I'll just go through a couple and we'll try to tie them into the Higgs scenario. This one here, first one is kind of a little more complex on a topic we don't cover too much, and that's, you know, capital management of the company. But when we think about the balance sheet, where the company has a lot of investment assets and they want to match the liabilities, if the liabilities are increasing because of the claims liabilities, they might not have enough investments to offset the size of the claim liability. So they could use reinsurance as another way to reduce the net liabilities because they'll have some reinsurance recoverable assets. So if there was some type of capital constraint where the company didn't have a lot of access to capital, then they could use reinsurance because it reduces their net liabilities because the claims recoveries, right? Gross claims less the ceded claims would be their net claims. Increased capacity offered to the insureds. right? So in this case, if a company is allowed, based on their capital structure, to offer only limits of say 10 million, but their policyholders only want to deal with one broker or one insurance company, but they need a policy for 100 million. So the insurer doesn't want to necessarily lose that relationship with the policyholder. So they might say, okay, I could offer you $100 million policy, and then which they would write that policy. And then the insurance company might say, well, I could only keep the first 10, and I'm going to find reinsurance partners for everything over 10 up to 100 million. So that way the company gets to write the most that they can, right? 10 million, but they keep the relationship with the policyholder by finding those reinsurance partners. Okay, so that would be another reason. So that type of reinsurance would be like an excess of loss, where the company could take the first 10, and anything in excess of it, they're going to find a reinsurance partner to, for a premium, be responsible for those claims. Okay. So here's one that comes up a lot in potentially in that HIG case study scenario, when we talk about stability and catastrophe protection. So this would be protection that, when a large loss happens, a large event, the insurance company might see a large spike in their claims if there's a storm, hailstorm, or a fire or something like that, like a forest fire. So what they could do is buy catastrophe protection, say, look, if there's a CAT event, I'll pay you a premium, but then you cover all the losses related to a CAT event or part of the losses. So what that does for the insurance company, it's because they're giving up premium, their loss ratio could be steady. And if a claim happens, it's not a big impact on the net claims because they have the reinsurance. So over many years, they're paying premiums so that when the large loss does happen, then they have protection. So that smooths out the loss ratio for the primary company, for the insurance company. Okay, so that would be catastrophe protection, again, using an excess of loss type treaty. So the last reason we have here is, if they wanted to enter a new market, like a new line of business, or they could use reinsurance to exit a product line. So a couple of reasons that this would come up, that if the reinsurer has expertise and they would truly act as a partner with the insurance company, so the insurance company would be able to sell a policy, which the reinsurer helps price, because if they have the expertise, then the company could issue the policy to the policyholder, and then together they share the premiums and the claims on that specific type of portfolio or risk or product line, whatever it is. So over time, the company may then gain the expertise of how to write and price and underwrite this product line, and then they would gradually use less and less reinsurance, depending on that relationship, as the company gains that underwriting expertise over time. So in this case, when it's a true partner, they probably would use some type of proportional reinsurance, where they're truly sharing equally in the premium and the claims of that policy or that portfolio. Similarly, if they wanted to exit a portfolio, so I'll give you two examples that I've seen for both of these. So entering a new line of business, a lot of companies, for when cyber was first coming out, they wanted to, create their cyber policy, but without the history of claims, not knowing how to underwrite, the reinsurers, who are more global, had some expertise in underwriting cyber risk, because they, not just in Canada, but globally. So the reinsurer would provide their pricing and help Canadian insurer create their product, coverage, the wording, the pricing, and then they did that knowing that they would then participate equally in the premiums and claims of that line of business. Now, if a company had a large portfolio, and I saw this, say, with lumber mills, that would be a line of business that, very profitable until, there's a fire at a facility, and then the loss ratio would spike. And, it's one that hard and soft market cycles really fluctuate. And I've seen some companies say, look, I have this large portfolio of lumber mills, I want to exit it, but then they would ruin the relationship maybe with the broker. So, okay, look, I'll still keep underwriting it through the broker to maintain the relationship, but I want to reinsure all of it or a large portion of it to a reinsurer. And the reinsurer may say, yeah, I like that business, I'll take it. You keep underwriting the direct, and then we'll reinsure you for all the premiums and the claims. So in the mind, the company's still writing it, but on a net basis, they've effectively exited the portfolio because they're not keeping any of it net. All right, they're writing it gross, ceding a lot of it, so their net is low. Okay, so it's more than just the financials. A lot of these are, relationships with the policyholder or relationships with the broker, and they could use reinsurance to maintain their net exposures. So, any questions, comments on that? I think it's important to understand, why a company would use it, and different types of reinsurance have different types of impacts the way claims are recovered, which is the next piece that we get into. Okay. So I talked about a couple of these different types of reinsurance when they would be used. So let's see here. We have treaty versus FAC. Okay, so the difference between those two is a treaty is an agreement that covers an entire portfolio. So what this portfolio means could be anything, whatever the agreement is designed. It could be all my small and medium enterprise business. It could be Ontario Auto. It could be anything I write with a broker X, right, or through an MGA. So it doesn't really matter what the portfolio is. The idea is that it's a set description that the insurance company and the reinsurers agree that anything the company writes fits that description is automatically included in the treaty. Okay. So what's different for FAC is that this is covered on policy by policy basis, an individual risk. So this one, if an underwriter is writing a policy for one policyholder, and it's either they need additional limits, or it maybe part of the policy includes a line of business that company doesn't want to write, then they would find a reinsurer for that one policy, and that's called a facultative agreement. So those are two different types of contracts. Both treaty and FAC could have proportional or non-proportional treaty, or non-proportional agreements. Okay, so FAC could have quota share or excess of loss, or a treaty agreement could be on a quota share basis or excess of loss basis. Okay, so what this means is if it's proportional or pro rata or quota share, all those mean the same thing. That just means the insurance company and the reinsurer are sharing the premiums and the claims in the same percentage. You get 25% of the premiums, they're going to get 25% of the claims. Okay. So something like this, quota share, wouldn't change your loss ratio, because if you keep 75% of the premium and 75% of the claims, that ratio of claims to premium stays the same, right? You're just sharing the dollars. It's just, you get the same percentage, same ratio of a smaller piece of that pie. Okay. Excess of loss, on the other hand, is where it's not proportional, so you're going to be paying, the insurance company is going to be paying a negotiated amount of premium, and then the amount of claims to be recovered, they don't know at the time, but it's based on certain thresholds on claims that are subject to that reinsurance agreement. And I think we got a question on this last time, and I think this is where that question came from, of what do these things mean here? That this loss could be applied to an occurrence. So it could be on like an event basis, which is where you get like a catastrophe. So it could be many claims that all happened because of ice storm that happened on February 11th, right? I just picked that day. So if any events happen and it's a cat, all claims would be grouped into a pool and then be subject to recovery under an excess of loss agreement. Or it could be on a per claim, like a per risk basis, which would look at all the policies on a certain claim, on a certain policy holder, whether it's one claim or multiple claims, or one location versus all locations on one policy. It could be designed to be insure me for one risk at a time. Or it could be an aggregate or stop loss over a portfolio. So this one's a little, maybe a bit more tricky to understand, but it could be that the agreement says the reinsurer is going to pay for claims if the insurance company has a loss ratio over 70% in total, then I'll take all claims over 70% loss ratio up to maybe 80%. So they'll take that next layer of claims that the insurance company has over a whole portfolio. We don't talk too much about this one. That's more complex. And there's other scenarios too, but the idea is the company is going to keep an agreed amount, and then anything in excess of that amount is covered by the reinsurer. So that description of quota share and excess of loss is the same as a treaty over a portfolio, or it is on a fact basis on an individual policy. Hopefully, I think this is probably similar to what you would have covered in another class. What we go into next is specifically looking at claim recoveries on these types of agreements. So this is where it'll be, we're branching off to the finance side. Okay. And this is one area where I did pull up those charts in last class, and you could go back to the recording. I'm not sure if we'll get to it today, but when I illustrated, when we do quota share, we do the illustration to stack it side by side for a specific reason that I'll describe now. So we're sharing premiums and losses in the same percent. The expenses are shared as a ceding commission. So this is how the insurance company recovers its cost from the reinsurer, but it's not just the broker commission that it recovers, it also recovers underwriting expenses and taxes. So the ceding commission that the insurance company gets is greater than just the broker commission. Okay, so I have an illustration that goes through that at the end as well. And why would they use this type of reinsurance? So what usually you would see this one if they wanted to enter new markets or lines of business, like that cyber insurance example I gave. And then managing the balance sheet is if they like their gross underwriting, but maybe their gross liabilities are too high, they need reinsurance to get that reinsurance asset to help manage their balance sheet would be another reason. So, and the reason we do it side by side for proportional, and this view is used consistently in the industry, that if you picture this as a scale, and as the claim dollars move up the scale, if this was 0 claims and 1 million, 2 million, 3 million of claims level going up. If you got to a certain level and then you look across, you would say, okay, how is the claim split? Okay, so you would say that if you go up 1 million, 25% is ceded and the company keeps 75%. Okay, the 100% amount is the gross amount. We're going to cede off 25 and then the company keeps 75 net. Okay. If it went up to, 2 million, again, I'm just using it as an example, you're still looking across and it's in the same percentage. 25% of the 2 million is ceded and the company keeps 75% of the 2 million. So you start at $0, work your way up, and then read across to see where what reinsurance applies. Let me just jump to how that's different in the excess of loss scenario, where we stack them. Okay, that's how we would illustrate an example of, in this case, 5 million in excess of 1 million. So that's telling us that the first 1 million, it's 100,000. You read across, it's all retained by the company. There's no reinsurance. If it's 500,000, no reinsurance. 1 million, no reinsurance. The company keeps all of it. But then as soon as you get to 1 million and $1, that $1 that's over 1 million is then reinsured, is then recovered from the reinsurance company as a ceded claim. Okay. If it goes up to, say, 2 million, that means the first 1 million is retained by the company, and then the next million to get you to 2 is then ceded to the reinsurer. Okay, so hopefully that illustration makes sense. When it's side by side, you read across, it's shared, and then here you could see it's stacked, which means the company has this idea of retention, their net retention of the claim. In this case, you could see it, the premiums are shared in the same percentage. In this case, it's just a negotiated premium. So the reinsurance broker and the reinsurer will look at the risks under the contract and come up with a premium that they want. It's similar to how an insurance company prices their policies, where they're looking at a risk to underwrite my house. They would go through their underwriting and say, I got to charge you X premium to reinsure my location. The reinsurers would say, here's my risk, which is all of the risk that the insurance company is writing. I expect there to be so much loss. This is how good they are at risk management. I'm going to charge them X premium for that policy, for that reinsurance contract. Losses are ceded to the reinsurer only after the company's retention is exhausted. That's the net retention of the contract. So they would use this type of reinsurance for stability in the loss ratio, and it protects the company from large losses and catastrophes. Because if it's a $2 million claim or a $5 million claim, the company's still just going to report a $1 million net claims incurred. Because anything over 1 million is being ceded. So their net is going to be at this retention level. So that keeps their losses stable. Okay, so here's the example for proportional. And I'm showing what we generally look at, the primary company. And then I'm also showing for the first time here what the reinsurer is recording, just so you could see that relationship. This is an example where we're ceding out 25%. Okay, so insurance company is going to be recording their premiums, and then they're going to be ceding out their 25%. Their net premium is gross less ceded is their net. The reinsurer is going to be assuming, remember gross is the sum of direct plus assumed. So they're assuming the same 30 million. They don't have reinsurance in this case, so their net premium is what they've assumed. And I'm just illustrating it here that it's the same thing happens for earned premium. So the idea of UPR and earning the premium over time works the same in this proportional scenario for the insurance company and the reinsurer. Okay. This is assumed earned premium. This is assumed claims. And here's their assumed commission. Okay, and this is the claim amount is 25% of the claim is being ceded and then assumed by the reinsurer. So what that means, and I talked about it when we talk about proportional, it doesn't change your loss ratio. If you do the premium and the claims in the same percent, your ratios are going to be the same. Okay, so proportional reinsurance contract wouldn't change the loss ratio for the portfolio that's being reinsured. Okay, so you could do the math, but the gross loss ratio of gross claims over gross earned, 65. You're ceding out 65%, so your net loss ratio is still 65%. Ceded claim ratio would be the 9,750 divided by 15, and the net is your net claims over your net earned. The reinsurer is assuming the same thing you're ceding, so their loss ratio is going to be the same. Their 9,750 divided by their 15. Okay. So this is the way that proportional, the companies are really partners because they're have equal percentage in the profits or losses of the business. So what's different here, the way that the insurance company receives its expenses, they might pay out a broker commission of 10%, but they have to recover their underwriting expenses and premium taxes. So they're going to be using ceding commission, which is income for the primary company, a higher percentage of premium so that they recover those other costs. Because the reinsurer would have less costs to underwrite to issue the policy. They wouldn't have to pay the premium tax because that's only the direct premium pays the premium tax. So that's how the insurance company, where do I have that note here, collects all their expenses. Okay. Any questions on proportional, how that comes through the financials? We're going to jump to excess of loss. And going through the examples that we could pull up after that I gave you as practice questions last week, it just gives us more scenarios. But in this case, we wanted to look at claims 4 million in excess of 1 million. Okay, so that means the reinsurer is going to pay $4 million only if the claims are over 1. Okay. So I have 3 different claim examples here with the gross claim, ceded, and the net. So we'll go through each one just to see what this ceded amount of the claim would be in this scenario. So in claim number 1, the insurance company has got a claim of 900,000. There's no ceded claim because 900,000 is within the threshold of the company's 1 million net. So the gross amount that's ceded, here's the net for the insurance company. Claim number 2 is 1.4 million. So the company keeps the first million. Anything over that, they're allowed to recover from the reinsurer. So 1 million that they're keeping minus the 1.4, they're allowed to recover 400,000 from the reinsurer. under this excess of loss reinsurance agreement. Gross less ceded is the net 1 million, okay? Claim number 3 is a $4 million claim. We apply that same logic that anything over 1 million, we're allowed to recover. So if we take 4 million less the 1 million we keep, we're allowed to recover 3 million from the reinsurer. So that means our net is 4 less 3, net of 1. Okay, so my last note here is with coverage in excess of 1, that would limit the net claims incurred to whatever their treaty agreement is, 1 million, on an individual claim or per risk or event or whatever the agreement is. One thing to note is that this agreement specifically, and we talked about it last week too, the reinsurer is saying, I only want, the most you could send me is 4 million. Okay. If this was a $10 million loss, the most you could cede to them is 4 million. Because they're saying, I'm only covering you for 4 million in excess of 1. Okay. So in the case, if it was a 10 million, less the 4 you could recover, the company is going to have a 6 million net. So why don't we, it's 12:30. Why don't we take another 5 minutes break? I'll come back with the practice questions, and we could go through a couple of them and then see if you have any questions on the practice questions. Okay, so let's take a quick break here, and we'll get that ready, and then that'll be it for the class today. Okay, everybody, I am back. I just actually uploaded the practice questions from week 9. I just uploaded the answers to Blackboard as well. So these 2 worksheets that I'll share are now on Blackboard for you to review too. Also, as I mentioned, how to attack these questions is the step-by-step guide is at the end of workbook number 2 as well. Anybody have any questions related to what Professor John thought? Anything else that you've been thinking about before we get into this last part of class today? Let me know. Okay. So come on. Here's the chat. Okay. All right. So here we go. We got the claims one, and I do have the answer key here. So I'll just help guide through the steps and some of the terminology to use, because that's the other part, right? To make sure we're using the right terminology here. So where I would start with this one here, you're asked to populate the shaded amounts. Hopefully you can see that clearly on your screens. So this idea of current year loss ratio is the net claims incurred for the accident year that's of the current calendar year that you're in. Okay, so the 2018 current accident year ratio would be claims of accident year 2018 in calendar year 2018. So this is your current accident year claims for 18, 6,405, and then all the ratios are over earned premium of that same year. So you would take your 6,405 divided by 10,500. But what they're giving you here for 2019 that you're solving for is that your loss ratio of 68% for 2019. So that means 2019 current year, accident year, and calendar year. So this would be 68% of your 11,025. Okay. This bit here, that this current accident year amount includes a catastrophe of 10% of the earned premium. That's for the next schedule below. That's included in your current accident year amount. The question is telling you that you have favorable prior year development. Okay, so we talked about this term prior year development. So what that's saying, this is from prior accident years. You thought your losses were going to be X. Now you have a better estimate of what they are because time has progressed. There might have been more claims reported. There might have been, the absence of claims being reported, or claims that you knew about actually were settled for less. Or it could be what claims you knew were settled for more, right? So that's why this development could be favorable if it's less, or it could be unfavorable if there's more claims. And we keep track of it by each accident year. Sometimes companies might report on their total prior year development over all prior years, but let's start this question anyways by looking at it year by year. So it's telling us in this calendar year 2019, we found out that we have favorable development for claims accident year AY 16 was 1,000. So it's favorable, which means we have less claims. So we have a negative 1,000. And we'll drop into 500 for 17 and drop into 2,000 for 2018. All negatives because the question's telling us they're all favorable prior year development. All of this activity in the net incurred claims happened in 2019. And what we report on our financials is the sum of all of this, the net claims incurred, which is the total, which shows up on our financial statements. Right? So if you just looked at this company's income statement, you would see this 3,997, quite low. But then when you break out how much of it was related to losses in 2019, it's the 7,000 amount, and there would have been negative amounts in total, 30,500 of favorable prior year development. So if we just think about, you know, in this scenario, all of these prior year developments in all the years in this part of the triangle has always been favorable. So what that, you know, would mean is the company is maybe always estimated their claims on a very conservative side. So if they think that their portfolio is going to operate at a 68%, maybe they're reserving at 70, and then the next year goes by, it's okay, we have all this, maybe it's IBNR. Now we've had some paid claims in cash, we have some case reserves put up, so now we could drop our IBNR down. And what that ends up being, the net of all of that activity ends up being a reduction of the claims. Okay, so let's just use this example for 2017. In 2017, we had net claims incurred. Or net claims incurred is what goes through the income statement, of 6,100. That might be made up of a large amount of IBNR, a little bit of case reserves, and maybe there's some paid claims. Okay, remember we talked about all those different types of transactions are part of your net claims incurred. Paid, case reserve changes, and changes in IBNR. As 1 year goes by, so what, you know, at the end of 2018, we looked at all of our reserves and claims payments for this accident year for any claim that happened in 2017. And now it might be, okay, we have paid out, more of those claims have been settled. We've increased some case reserves because now we know about these claims, but we could reduce our IBNR because maybe that claim activity hasn't been as high as we thought. So there's all these movements in net claims incurred that we're keeping track of. And then as time goes on, again, more claims are paid out. Once it's closed, then you don't need the liability, you don't need the reserves up any longer. So time goes on, you pay the claims, you could reduce case reserves, you could reduce the IBNR. And we keep track of it by year. And in the end, or at least after 2 years, any claim that occurred in 2017, we only needed net claims incurred of 3,600. But it took us, you know, 3 calendar years to get to that point. And it might still develop for more years as well. Okay, so that's the idea of how to think about it and why a company is going to have prior year development, whether it's favorable or unfavorable, because so much of it in the current year is just an estimate based on the actuarial reserves. Okay. So when we look at what's actually happening in this calendar year, we want to unpack it a bit further. Because these are the ratios that they're showing in total net claims incurred over the earned premium for the year. Okay, very, very low, like unreasonably low in this example. One that was missing here, you know, would be the 2017 total claims over earned premium. Okay, that's that ratio, total claims over earned premium. That's what it tells you here. This is what's on the financial statements that we've been talking about on the midterm and all along. Now we're getting into this idea of breaking out prior development in total. So all prior accident years are shown here as favorable prior development. You can see from the formula I'm adding all 3 of the amounts. 1, 2, 3, right? All of these are prior year development in 2019. And then we could present that as a ratio of earned premium for that year. So if we follow what was asked in 2018, it's these two amounts for prior development reported in 2018. Okay. Happens to be for accident year 17 plus accident year 16 and prior. If we two ways to get at the current year. So a current year is the total excluding the prior year development. So in this case, we would minus the negative amount to exclude it. So our current year is 37 minus the negative 24. So 37 plus 24 gives us the 61 in 2018. Okay, it's the same math for these other years. Or we could look at, I mean, the formula is given here. We're looking at current accident year net claims incurred. Right, so I know it's getting complicated because is a claim amount not just the claim amount? I said, no, I'm introducing that we have total net claims, we have prior year claims, we have current accident year claims, and we're going to end up talking about CAT and large loss claims. So let's just look at, we're looking at each one separately, current year claims. We could do that as a ratio of net earned premium. And if you follow the formula there, we're taking just our current accident year claims over that current year earned premium. Okay. 2019 ratio is going to be this amount. This one you should get because this is the actual one that you inputted from the question, right? We started with the current year ratio being 68%. So we actually calculated this one, which means that should be exactly what you come up with down here in the chart. If there's amount of large losses, 10%, that was actually given in the question as well. That'd be a ratio of the earned premium for that year. This is the other key term for the loss ratio, and this is our attritional or underlying. And we looked at, this is where it's inconsistently used in the industry. Some companies call it attritional. Most, I think, now call it underlying. Aviva, I think, was calling it, Economical was calling it core. So whatever it is, how they're using that term, you would have to maybe look at the definition if you're not familiar, but they would describe it as being their loss ratio excluding prior year development and catastrophes. That's what this column is. So we have our loss ratio excluding prior year is the current year, less excluding these large losses or CATs, then you could get down to an attritional loss ratio. So the reason they do that and the reason we spend time on it is because this takes out all the noise from unusual items that don't happen every year, and you could argue are not related to the premium that you're underwriting right now. Okay. Of course, there's still some risk in premium you're writing now to CAT and large losses, but the idea of pulling out the large volume is that this type of activity shouldn't happen every year, right? So we could look at, we do have a CAT risk, but I don't want it to hurt my look at underwriting performance for the current year. I'll look at it as a portfolio over many years. So let's take out the noise of those unusual items and we can analyze this attritional or underlying loss ratio. Okay. Okay, so these views, this is the last point here. And again, use the workbook to guide you step by step. But what this is showing you is that for now I have accident years in the rows. Okay, so the first column had accident years in the columns. Just want you to get familiar that these triangles could be presented in both ways. So if the accident year is in the row, in the first year, this will be the current accident year. So 2017 in 2017. And then 1 year later, what are my incurred claims for 2017 accident year? So I've decreased it by 2,000. And you can see the formula. So what that's doing is reading down. I was at 6,100. Now, after 2 years, my total claims is the 6,100, less favorable development. I have less claims. So now I think my total claims 1 year later for 2017 is 4,100, the sum of these two. And if I go into the third year, my total claims for 2017 are 3,600, the sum of all three of these amounts. 61 less 2, less another 500. So this view just tells you that, okay, I could see that my claim amount in total for accident year 17 is decreasing over time. And in 18, that claim amount decreased over time. If you ever see these in the industry, then you would, you could make assumptions, or, in the next year, are we still decreasing? Every year I write it, would I assume that 2019 is going to have favorable development in the same magnitude that 2018 and 2017 had? So that's very advanced. That's some of the trends that actuaries will look at, but an underwriter over time, when you talk about what type of rate increases do I need to support the losses I'm going to have, would look at, you thought I was going to have this much of claim, but really I only had this much, so really I could have charged much less premium, right? Would have had less profit, but if I lost business because we were charging too much premium, then you would have to recognize the impact that you were reserved so high before, but really you only had this much of claim. So that's the type of discussion that's quite advanced, but that's where it leads to an understanding these types of analysis. So these amounts are the dollars. This is the percentage. So this row here would all be divided by 2017 earned premium. And then you could see that my loss ratio originally was 761, and it's actually only ultimately goes to a much lower number. Last diagonal, the way the triangles work, would be this is where we currently are at this point in time, right? In this example, it's the end of 2019. This is what I think 2019 losses are now. This is what I think 2018 losses are right now. And this is what I think 2017 losses are now. So this gives you the current view of where the loss ratios have developed over time for each accident year. Okay, so that's another way to view or to interpret the information that's in these types of chart. This is a lot of, oh, I didn't even get into the reinsurance ones. Shoot, I spent too much time on claims. Hopefully that was helpful though. On the reinsurance one, the answer key, hopefully just use it as a guide. I've included formulas to help you check the logic in getting to the responses. What this is asking for is also the premiums. So first column is proportional, and we have two types of excess of loss. So let me just spend 5 minutes to get this introduced, and then you could go through as a practice as well. There's additional practice question in the workbook. So in the case of just looking across the premiums, the proportional case, however we're sharing the claims is also how we share the premiums. So if it was 200,000 of gross premium, we're going to be ceding away 50% of it to the reinsurer. So the net is gross less the ceded is our net. for the excess of loss, it's not a proportional premium. You could read in the question, it says that the excess of loss premium, a premium of 30,000. Okay, so we capture the 30,000 premium. In this excess of loss scenario, the premium is 20,000. So we have our ceded premium less than what it was here. So our net 170, gross less ceded, and in this scenario, it's gross less the 20,000 of ceded. You have a net of 180. Okay. The math for the proportional claims under each scenario is simple on this side in that we're going to be ceding out 50% of the claim in every case. Okay, so it's all the same. We share it evenly with the reinsurer. The check in this case that you've got all the math right for premiums and the claims, you'll notice that the loss ratio for the gross amount is 34, we're ceding out 34, and our net is 34. Remember we talked about in a proportional reinsurance scenario, you're going to be sharing the loss ratio. You're not changing your loss ratio with proportional reinsurance. So the excess of loss, we'll just do one example in each of the scenarios. So if you wanted, you could draw your chart, which says that the first 10,000 is what our retention is, and then anything over 10,000 is what we're going to be ceding. So you could picture that stacked illustration of this excess of loss program. So as we move up on this claim for 20,000, we're going to keep the first 10. So how much of this 20 is in excess of 10? So we do 20 less the 10 we keep. So that means we're allowed to recover 10,000 from the reinsurer. So the net is our gross less the ceded is our net. Now it's just by coincidence that it happens to be the same as the 50%, but that's very different math because we're looking at how much of this gross claim is over the 10,000 excess. Maybe I should use claim number 3 as the example where we're actually getting different results. So same idea for the 40,000. How much of the 40 is over 10? So if we have 10 we keep, that means 30 is in excess of the 10. So we're going to reinsure 30,000. Company keeps 10, insure 30, that gets to the 40,000 of claim. Our net amount is our gross less the ceded is our net. Our net in this case should never be in excess of 10, because anything over 10 is being reinsured under this reinsurance agreement. Now, this excess of loss option 2 is a little bit different. We still are ceding everything in excess of 10, but we're only allowed to recover up to a maximum of 15,000 from the reinsurer. So this would be noted as being 15,000 excess of the 10,000 loss that the company keeps as its threshold. This is the last piece for today, so stick with me here. We have our 40,000. How much of that is going to be recovered? So we're going to keep the first 10, but we could only recover up to 15. So the most we could recover is the 15, and our net is our gross less the ceded. So I think I have an illustration of this one from last week. Come on. In class, here we go. That's not it. Give me one more moment here. Oh, shoot. Where's my chart? Here we go. Okay, so we did some of these charts last week. Down here is our excess of loss option 1, where we said all claims in excess of 10,000 would be reinsured. So if we had 10, we keep, and anything over 10, we start to cede. This one here, the yellow is the company's retention, and this peach color, or salmon, is how much is reinsured. All right, so excess of loss option 2 says 15,000 in excess of 10 is reinsured. Anything over that 15 in this simple scenario, there is no reinsurance. So the company can't have any ceded recovery of claims once it gets into this yellow area again. So in our question that we're doing right now, the example is 40,000. So if we go up to 40 on this excess of loss example, the company keeps the first 10, then we could cede away the 15, and then that just means anything in excess of the 15, there's no reinsurance. It's the company's share. So where are you? So that's what this is saying. We could cede out maximum 15. Our net is 40, less the 15 is 25. Okay, so whenever you get these types of scenarios, doing a quick chart makes sense. Remember, I did illustrate that, you know, in reality, there's complicated structures with multiple layers of reinsurance that stack together. And you could have a scenario where it's a layer is split between, it could also be split where a layer is proportional. Okay. So I'll leave it there. I'll save the recording up on Blackboard today, just in case we do get cut off. Things to work on while we're gone is the group project. Test number 2 is open, so you could start working through those examples. I have the answer key for these 2 questions that we just did up on Blackboard as well, so you have that as a resource as well as workbook. If you get stuck or have questions, you could reach out to me on LinkedIn. Good luck, not just with this class, but in all your other ones. And one thing I did notice, I saw that Professor John indicated that it was like Wawanisa week this week. So hopefully you guys took the opportunity to go to MSA, look at their financials and some of the summaries that they have on Wawanisa. You went to Canadian Underwriter to do the snapshot of the outlook that the Wawanisa folks had presented. That just gives you a leg up, and then you can make connections when you're hearing them speak. How does what they're telling you, in whether it's claims or underwriting, relate to their results or relates to their outlook and vision that their CEO would have shared? So don't forget about those resources. I'm going to stop the recording, but I'll stick around for 5 minutes.